Hi everyone, my name is Victoria Holcomb. I am an associate here at Bogart Wealth under the Advisor Growth Track. Today I will be talking about Credit and Investing 101 for April's Financial Literacy Month. The agenda today is going to be talking about credit, your credit score, your credit report, how to build credit, some tips on investing and savings, having a retirement plan, and a quick financial checklist for you. So what is credit and why you need it? So first we're going to talk about what is a credit score. Basically, that is also known as your FICO score. A credit score is a number that helps a lender predict how likely an individual is to repay a loan or make credit payments on time. So basically, you can think of a credit score as your friend or a referral. You really want a positive referral, and so your credit score, the higher the credit score, the more positive your referral is going to be. So credit scores are not automatically offered with your credit report. A credit score is a number that changes as the elements in a credit report change. FICO scores, one of the most common credit scoring systems, vary between 300 and 850, 300 being very poor and 850 being very exceptional. The higher your credit score is, the better interest rates you will be charged to borrow money or use a credit card. What is a credit report? A credit report is a detailed breakdown of an individual's credit history prepared by a credit bureau. Credit bureaus collect financial information about individuals and create credit reports based on that information. Lenders use the reports along with other details to determine loan applicants' credit worthiness. So what is in your credit report? So there are about 5 different categories that are involved in your credit report. First, you have your personal information, which includes your full name, date of birth, your address, and it might also include your occupation. Trade lines are your mortgage, car loans, and any credit cards that you may have. That will include any revolving payments or installments that you have on those mortgage, car loans, or credit cards. Delinquent accounts are anything that you have a balance that's overdue. Public records include bankruptcies and collections. A good example for collections could be a medical bill that hasn't been paid. Depending on the length of that medical bill that hasn't been paid, it will go to collections and then that'll be marked as on your public record and could be negatively impacting your credit score. Inquiries, there's 2 types. These are credit pulls, so you have your hard inquiries, which occur when you apply for a new credit or services. Hard inquiries are also involved when you are looking at cars. So if they ask to pull your credit score, that is going to be a hard inquiry, and you can get docked for that, which we'll go into a little bit more later. Soft inquiries is a credit check that does not damage your credit score in any way. So who looks at your credit report? Number 1 would be lenders, and this is credit cards, store card lenders, auto loans, mortgages, personal loans. A lot of lenders want to see if you are going to be a good candidate, you're going to pay back your loan on time. They're going to make sure you have a really good credit score and that you are able to pay what they lend to you. The next will be utility companies. So this could be your electricity bill, water bill, gas, things like that. Cell phone companies will also take a look at your credit score or your credit report. Your insurance carrier will also look at your credit score and credit report to make sure you know that you're responsible and that, again, that you can pay your payments on time. Employers want to see that as well. Military for security clearances, rental agents to make sure that you're able to pay your rent on time, and banks for any personal loans. How can you get your credit report? There are 3 credit report agencies. You are entitled to 1 free credit report every 12 months from each of these credit report agencies. So we have Equifax, TransUnion, and Experian. You should also know that some credit card companies also provide your credit score and updates at no cost. Reviewing your credit report. You should check for errors, use credit report review checklist. If there is an error, you need to contact each credit reporting agency to dispute the error. That's going to be, again, Experian, Equifax, and TransUnion. You should also keep copies of all correspondence pertaining to a dispute. The credit report agency is required to conduct an investigation. If the agency finds that the item you disputed is an error, they will correct it. If they find that the item is accurate, the item will stay on your credit report. How are credit scores calculated? So the credit score is actually broken down into several different categories that affect your credit score. 35% of your credit score is going to be impacted by your payment history. That means, have you paid your credit payments on time? Have you paid it before the deadline? Have you paid it in full? 30% is going to be the amount owed. So that's going to be the balance of your credit card, your loans in total. 15% is going to be the length of credit history. It's going to see what is your longest credit line. So that can be your oldest loan that you have, student loan, mortgage loan, a car loan, personal loan, or your oldest credit line from your credit card. If you, for example, let's say you have 3 credit cards and you close one out, and if that credit card was currently your longest standing credit card, that could have a negative impact on your credit history. So that could dock you some because you have basically shortened the length of your credit history. 10% is going to be your credit mix, and 10% is also going to be your new credit. So how to build and maintain good credit. We want to consistently pay all bills on time. A good goal to strive is to pay off balances on credit cards every month. And if we can't do that, we want to at least keep the balances as low as possible and pay the minimum balance due each month. Do not apply for a credit card if you do not need it. Make sure to provide accurate information on all credit, loans, and any other applications. Open secured credit cards. Secured credit card requires you to provide a cash security deposit to open an account. You should put small amounts on a credit card every month and pay off in full every month as well. You can also become an authorized user on a relative's credit card. Children can build credits from a young age as a teenager and can be an authorized user on parents' cards to start building credit. So, for example, if you're a student, obviously you can't open your own personal credit card until you turn 18. A good opportunity for parents is to put them as an authorized user to build credit. This helps them in the future when they get out of college or they need to rent a house or buy a car. This will help them. If renting an apartment, ask landlord if they can report your rental payments to the credit reporting agencies. You can also work with a financial coach to develop a plan to pay off past due items in collection and/or any other judgments. Next, we're going to talk about the credit utilization ratio. Your credit utilization, which is the amount owed, is 30% of your credit score. Strive to keep your credit utilization ratio under 30%. A credit utilization ratio over 30% can either lower your credit score or make it more costly for you to borrow money. For example, a credit line of $30,000 should maintain a balance of less than $9,000 at any given time. So how do we determine your debt-to-income ratio? In addition to looking at your credit report and score, lenders will also look at your debt-to-income ratio to determine if they want to lend you money and if so, at what interest rate. So your debt-to-income ratio does not affect your credit score. However, your DTI helps determine if you are able to take on more debt or if you have too much debt. To determine your debt-to-income ratio, you add up all your monthly debt payments and divide it by your gross monthly income. Monthly debt payments include mortgage payments, auto loans, personal loans, student loans, credit card minimum payments, and other monthly debt obligations. So below we have listed the mortgage debt-to-income ratios as a guideline. 35% or less is generally viewed as favorable and your debt is manageable. You likely have money remaining after paying monthly bills. Anywhere between 36% to 49%, your DTI is high, but you may still qualify for a loan. However, lenders might ask for other eligibility requirements such as a cosigner, additional money for a down payment, or they might charge you for a higher interest rate. 50% or higher means you have limited money to save or spend. As a result, you won't likely have money to handle an unforeseen event and will have limited borrowing options. Just a reminder, these limits are often viewed for those with a mortgage. If you don't have a mortgage, strive to keep your DTI below 20%. So how do we maintain good credit? First, you want to pay all your bills on time. You want to avoid late fees. You want to review your credit report at least once a year. Check to make sure it is accurate and report any problems with it immediately. Keep the balance low. Paying off the balance each month is best. Avoid frequent credit applications or account inquiries. Basically, do not live off credit or be tempted to use credit to spend beyond your means. Pay yourself first. Getting in the habit of saving can help build wealth over time. A systematic approach to saving and investing is a good idea. You should put money in savings as if it were a fixed expense. Invest the same dollar amount at regular intervals that can be monthly, bi-monthly, or quarterly. You can even do weekly if you think it's easier for you. Set up a monthly automatic allotment to go directly into an investment or savings vehicle. You should create a savings and investing plan. Review your financial goals and establish saving buckets for your goals. This can be emergency fund savings. This should typically be anywhere between 3 to 6 months of your expenses. So for example, let's say your monthly expenses, which include your rent, gas, utilities, is, let's say, $2,000 a month. You want to have up to 3 to 6 months worth of that. So that's going to be, for 3 months, it's going to be $6,000, and for 6 months, it's going to be $12,000. You can also have short-term savings goals, which could be saving for a vacation trip later in the year. Midterm goal savings can be saving for a new car or paying off your student loan. Long-term goals savings are essentially your retirement savings. Use automatic saving methods. Set up an automatic transfer from your checking account or paycheck to each of the saving buckets each month, preferably on the same day as your payday. Save all or part of unexpected income. You can designate your tax refund, annual bonus, tip money, or proceeds from garage sales to savings. Next, we're going to discuss a little bit more about savings versus investing. So what is saving? You can accumulate money relatively risk-free through savings accounts, certificate of deposit, CDs, money market accounts, U.S. saving bonds, or U.S. Treasury bills, also known as T-bills. These are typically used for short-term needs. For example, upcoming expenses, emergency funds, near-term expenditures. They typically earn a low fixed rate of return, which is also known as an interest rate, and are protected by Federal Deposit Insurance Corporation, known as the FDIC. These are liquidable, which means that they can be withdrawn with ease and quickly. What is investing? Investing comes with risks of loss. The goal is to earn higher, longer-term returns. Through the purchase of securities, which are stocks, bonds, or mutual funds, risk levels will vary depending on the types of securities you purchase. Investing can offer a higher or lower rate of return than savings. They are used for midterm and long-term financial planning. Next, we'll be discussing planning for retirement. So what are employer plans? First, we have the defined contribution plan. Employees and employer contributions are specified, but the benefit amount is tied to investment returns, which are not always guaranteed. Then we have the defined benefit plans. Sometimes they're also called pension plans. The benefit amount is predetermined based on your salary and the years of service. So what does it mean to be vested in my 401k? First of all, vested is a term to determine how much of the 401k funds you can take with you when you leave your company. For example, let's say you have a plan that increases the amount you are invested in your plan each year by 20%. After 5 years, you will be fully vested, meaning the employer matching funds will belong to you. If you leave your job after 3 years, you will be only 60% vested. You should try to strive to contribute 10 to 15% of your income to your retirement, including the amount your employer matches. Some companies vest immediately and others over time. Talk to your benefits team to learn more. Always go for a full match if offered by your company. IRAs. An IRA is an investment account with tax advantages that individuals can open to save for retirement. Just like with employer-defined contribution plans, investment growth in IRA isn't taxed each year. Since more dollars stay invested, the account can grow faster than a taxable brokerage account where you have to pay taxes on the growth every year. You can begin withdrawing money at age 59 and a half. Before age 59 and a half, you may have to pay penalties and taxes. The two typical types of IRAs are traditional IRAs and Roth IRAs. Okay, lastly, we will be writing you an example of what a financial checklist should look like. You should review this financial checklist every 6 to 12 months or when a life event or change in income happens. You should review your financial goals and spending priorities every 12 months or after any life-changing events. Do you have 3 to 6 months of living expenses saved in an emergency fund? Are you saving for retirement? Work to save 10% of your income in your 401k, including your employer match. Review your credit report at least every 12 months and before applying for a loan. You should review your insurance coverage at least once a year. How much and what types of insurance you need depends on your circumstances. Know what natural disasters are covered by your standard homeowner's insurance policy or renter's insurance policy, and make sure you are adequately protected. Review your estate planning documents every year and when you have a major life event. A strategy for building wealth. First, you should pay down debt. Second, you should contribute up to the match of your retirement plan. For example, if your employer matches 6% of your income, you should contribute 6% of your income to your retirement plan. Build an emergency saving funds of 3 to 6 months. Number 4, go back to your retirement plan and max out. Lastly, you want to start building non-retirement investment accounts. This can look like an individual brokerage account. And that wraps up today's presentation on Credit Investing 101. I hope you enjoyed it, and thank you.